Good morning again, learners. So now we are doing part 3 of the financial statements, and it looks like this part will have a lot of subsections. So part 3 is year-end adjustments. There is a number of year-end adjustments, as you can see, but we are going to tackle them one by one. So now we are going to do depreciation. So depreciation, what is depreciation? So let's start from here, from this. Depreciation can only happen with fixed assets. So the fixed assets we know is vehicles, equipment, machinery, and land and buildings. It does not happen with land and buildings because depreciation means the value of the asset is going down. It's depreciating. But land and buildings, the value of land and buildings goes up all the time. So you will never see depreciation on land and building. So the other three, you will see depreciation. But machinery happens in a factory, so you will only see it when you're doing cost accounting or manufacturing. So for now, we're going to deal a lot with equipment and vehicles. So when you buy a vehicle today for 200,000, next year, same time, it won't be worth 200,000. Actually, when you drive it out of that place, because there's kilometers on there, it's not worth 200,000 anymore. So the accountant needs to work out how to calculate the value now. Which one? How much are you depreciating? How do you record it? And how much is remaining? How much is the car worth now? There is terminologies for it. I hope we'll get to it now soon. So there's two methods of calculating depreciation. The first one has two names. This one on the left is the first one. You can call it cost price method, or you can call it fixed installment method. And then the next one is called diminishing balance method. This is the methods you use to calculate depreciation. Remember, it's not three methods, it's two. This one has two names. I'm teaching you both because I don't know where you are reading which method they're going to have. And then you've got the diminishing balance method. So let's have an example. Work it out on an example. So on 1 March 2019, they bought equipment for 65,000. Depreciation must be provided for at the rate of 15% per annum. Calculate using each method. So the one important thing now, you have to know how much it was bought for in order to calculate the depreciation. And then you must also know the rate of the depreciation. That's what. So it's 15. It ranges from 15%, 20%, 10%, depending. You can even get it for 25%. So let's go and let's work it out now. So the cost price is 65,000 and the rate is 15%. Let's start with the first method, which is the cost price and fixed installment method. This is the easiest actually. So the cost price doesn't change. You never change. Remember the historical cost principle, the GAAP principle called historical cost. You don't change the cost of the equipment or asset. Then the depreciation rate also doesn't change. It's going to be 15%. So let me just write 15%. It won't change. And then let's just make this faster, 15%. Then now we'll calculate depreciation. So at the end of each year, the accountant has to calculate depreciation. So so we bought it in 2019, 65 at the beginning of the year. Because if you look at this, it says 1 March. So we've got 12 months to depreciate. So I'm going to use this method. So you are going to say, this is what you're going to say, 15%. You're going to say 65,000 times, what is the depreciation rate? 15%, 15%, which is 15 over 100. And then how many months did we have it for? 12 months. So you're going to say 12 over 12. If we had bought it in the middle of the month, then you count the months that we had it. So, but don't worry about that for now. So this is the method. So 65,000 times 15 over 100 times 12 over 12. Do I have a calculator? So that should give us, I think that should give us 9,750. So you are done. If you're calculating this one, you're done. This is the only calculation you need. If you're using the cost price or the fixed installment method, it's very easy. This is the only calculation you need. So I'm going to come back here. So depreciation is 9,750. Next year, you're calculating it the same way. So that's why I'm saying you're done. It's going to be the same. Then, yeah. So anyway, so let me just put all of them, because that's the calculation until the 65,000 is finished. You cannot go over the 65,000. So if I stand here, it gives us 48,750. So it's not finished. So I can write it. So now I wanted to now teach you so this is a new account. Depreciation is a new account, and it's an expense account because you are losing the value. There's an expense. Depreciation is an expense. But since we can't, so now I'm teaching you the contra account. What is the contra account? Since we can't reduce the cost price, like the 65,000, we come up with a new account called accumulated depreciation. This account is a negative asset. This is the classification of this account. A new classification called negative asset. It's not an asset. It's a negative asset because it's reducing on the asset. So accumulated depreciation, accumulated means add up. So it's the depreciation of the years. So year one, we only had this depreciation, so it's going to be the same. It's going to be equals this one. It's going to be that. Year two, we've got this depreciation and this depreciation, so it's going to be both of them. So you're going to say accumulated plus the current. So I'm going to say equals accumulated plus the current depreciation. That's how you calculate it. And then for year three, it's going to be the same thing, accumulated plus the current. And then year four equals accumulated plus the current. Year five equals accumulated plus current. So you keep going. Depreciation, you keep, as an accountant, you keep going until you get to 65,000. Then you're done with depreciation. So we will have, it's just that we're in 2023, so I'm going to stop here for now, but we will have 2024, 2025 until we finish this. Carrying value is now the value of the equipment at the moment now. So the value of the equipment will be cost price minus accumulated depreciation. That will be the value of the equipment. So equals cost price minus accumulated depreciation. So in year one, at the end of 2019, which is now at the end of that year, then the cost of the vehicle, like if I'm to sell it now, I have to sell it at 55,250, not 65. 55,250. At the end of year two, it's also cost price minus accumulated. This is how much the car is worth now, 45,500. Then year three, 65 minus accumulated depreciation. And then year four, also again, cost price minus accumulated depreciation. And then year five, oh, what did I do? Minus cost price minus, so let's start over. Cost price minus accumulated depreciation. Oh, what did I do? That's fine. So this one, you know what, let me just make it easier. So and start over. So this one will be equals cost price minus accumulated depreciation. And then this one is equal to cost price minus accumulated depreciation. So at the end of year five, this is what the car is worth now, not all of this. I hope you understand the cost price of fixed installment method. Let's stop here for now. Thank you for watching and see you in the next video. Bye.